character of the moves. Are rallies being sold into? Are dips being bought less aggressively? Are volume spikes coming on down days rather than up days? Those are your breadcrumbs. And don't think reversals happen only at tops. Downtrends reverse too, and signs are similar, only flipped. A beaten down stocks making new lows. The volume on sell-off starts to dry up. Buyers quietly step in, not with fanfare but with patience. The public still calls it dead money. But the professionals are already building their positions. Have you ever noticed how the bottom feels most hopeless right before the turn? That's not a coincidence. That's how the market fools the most people. Trading is a constant test of perception. You're trying to see what others don't, or what they refuse to see. That's where the money is. But seeing isn't enough. You must believe what you see, even when it contradicts your hope. Because hope doesn't make you rich. Discipline does. Now, these three methods, price behavior, volume confirmation, and sentiment reading, are simple on paper but hard in practice. They demand that you observe more and act less. The crowd does the opposite. The crowd acts first and thinks later. That's why the crowd loses. If you want to be on the winning side, you have to train yourself to think independently, to question everything the market shows you. Ask yourself, is this strength genuine, or is it exhaustion disguised as strength?
What's faster, this brand new EV Dodge Charger or buying Bitcoin on the Gemini exchange? Let's find out. Buying Bitcoin on the Gemini exchange is convenient, secure, and fast.
When you can answer that question without guessing, you've arrived at a level of understanding that most traders never reach. And that understanding doesn't come from luck. It comes from hours, days, years of watching the tape, of losing money, of learning the hard lessons that no book can teach. Every loss is tuition. Every mistake, a professor. You know, there's a kind of calm that comes when you finally stop trying to outsmart the market and start trying to understand it. That's when you realize it's not about prediction. It's about recognition. You don't need to predict the reversal. You only need to recognize it when it begins. And if you can do that early, you won't just survive. You'll thrive. But make no mistake, the market won't reward impatience. You'll be tempted to call every pullback a reversal, every bounce a bottom. That's how traders get chewed up. You must wait for confirmation, but not so long that the move has already passed. It's a fine balance. The kind you can't teach, only develop through experience. Have you got the patience for that kind of learning? Most don't. That's why most lose. So when you open your charts tonight, I want you to forget the noise. Don't look for the next big thing to buy. Look instead for the subtle signs of change. Where is momentum shifting? Where is conviction fading? Where is the crowd still drunk on certainty while the tape quietly disagrees? That's where reversals are born, and that's where the professional prepares. Price hesitation signals the first whisper of reversal. Most traders never hear that whisper because they're too busy staring at indicators, waiting for a line to cross another line or for a candle to light up green. But the market doesn't speak in colors or lines. It speaks in behavior, in the pauses, in the hesitations, in the moments when the price starts acting differently than it used to. That's where the truth hides. When a market has been trending strongly, you'll see it move with confidence. The swings are smooth, reactions are controlled, and every pullback feels like a coiled spring ready to push higher again. But when that rhythm starts to change, when the once clean moves begin to stumble, that's the market whispering to you that something's shifting beneath the surface. I've always said that a trader must learn to listen to the market as if it were a living thing, because it is. It breathes, it hesitates, it reacts to pressure, and it grows tired. Price hesitation is the market's sigh. When a stock that's been climbing relentlessly suddenly starts pausing after every small rally, that's not random. It's a sign that buyers are starting to second guess themselves. They're asking, is this still worth chasing? And that hesitation spreads like a quiet rumor through the crowd. The public never notices it early because the chart still looks bullish at first glance. But if you look closely, you'll see a subtle change in personality. Candles that used to close strong now fade before the bell. Intraday rallies that once exploded now stall midway. Do you notice that kind of behavior when you trade, or do you only see the trend you want to see? In my own trading years, I learned that reversals never arrive with a drum roll. They sneak in through hesitation. It starts small. A stock stops making new highs even as the general market keeps rising. You might see the price stall near the same level for several sessions, as if invisible hands are pressing down on it. That's your first clue that supply is beginning to overtake demand. The tape might still look healthy to the untrained eye, but the pulse has changed. I remember watching leading stocks behave that way before major tops. The public was still excited, buying every minor dip, but I could see the tape struggling. The energy was different. When a trend is strong, buyers don't hesitate. They compete. They chase price higher. They swallow offers, and volume swells easily. But once hesitation creeps in, the balance of emotion shifts. The traders who used to fear missing out now begin to fear losing profits. That tiny change in psychology shows up in the chart before it shows up in the news. The range tightens, the pace slows, and the conviction fades. It's like watching a dancer who suddenly loses rhythm. Still graceful, still moving, but no longer in perfect time with the music. Most people don't see hesitation because they're focused on direction, not behavior. But a trader's real job isn't to predict where price will go. It's to recognize when price is acting differently than it should. If an uptrend has been steady for weeks, making higher highs and higher lows, and suddenly the pattern stalls, you should be paying attention. You might see 2 or 3 attempts to push higher that fail quickly. You might notice that each rally now ends sooner than the last. These aren't coincidences. They're signs of distribution.
I got waffles. How about you? Waffles! Woo! Get a free hot breakfast at Comfort Inn.
Right now at Raymore's Planning and Sleep Center, save up to $600 on Stearns & Foster adjustable sets and more.
The professionals are unloading their positions quietly, while the public still believes everything's fine. Have you ever been in a stock that looked strong right before it started falling apart? That's because you ignored the hesitation. The first hesitation in price is like the first crack in ice. It might look harmless, but it tells you that the structure beneath is weakening. And just like ice, once the pressure mounts, that small crack spreads fast. The trader who waits for confirmation from the crowd will always be too late. The crowd doesn't see cracks. It only sees reflections. They'll tell themselves, it's just a pause, or it's consolidating before another move. And sometimes that's true, but often it's not. Your job is to tell the difference. So how do you recognize true hesitation and not just normal fluctuation? It comes down to context. If price hesitates after a long, extended run, that's meaningful. The market doesn't move in one direction forever. Every trend ages, and hesitation is how it grows old. Look at how the candles form. Are the rallies shorter? Are the pullbacks deeper? Are the closes weaker? That's the market showing fatigue. In an uptrend, you'll see the stock start to close near the middle of its daily range instead of at the highs. The same thing happens in reverse for downtrends. Price stops collapsing and begins closing higher off the lows. Those are not random quirks. They're signals of a shift in power. In my early days, I didn't understand that. I used to think that as long as price was above my moving average, I was safe. But markets don't turn because of lines. They turn because people change their minds. And people change their minds slowly at first. The big traders, the ones who move real money, start to sense when a move has run its course. They stop pressing their bets. They take profits quietly. They sell into strength. That's what creates hesitation. The invisible tug of war between fading demand and growing supply. If you were to watch the tape carefully during that time, you'd notice that big orders start appearing on the sell side more often. The speed of trades changes. The bursts of buying that once pushed price effortlessly now meet resistance. It's subtle, but once you've seen it a few times, you'll never forget the feeling. It's like the air in the room changes. Something that used to flow easily now feels heavy. Do you ever feel the tension when watching a chart? That sense that price wants to go up, but something keeps holding it back? That's hesitation. Hesitation also shows up in how traders react to news. When a market is healthy, good news drives it higher, bad news barely dents it. But near a top, even good news fails to push price meaningfully higher. The enthusiasm is gone, though the public doesn't realize it yet. That's when you start seeing headlines like, "Market shrugs, off great earnings." The market isn't shrugging. It's signaling that the trend is weakening. Professionals recognize the behavior and begin to prepare. The public, on the other hand, thinks it's just a pause before another rally. That's the fatal difference. If you want to develop the skill of recognizing hesitation, you must learn to detach yourself emotionally from your positions. The moment you're too invested in being right, you'll stop seeing clearly. You'll interpret every pause as a sit up for continuation. But price doesn't owe you continuation. It owes you nothing. All it does is show you how other traders are feeling. And when the collective feeling shifts from confidence to doubt, the doubt shows up first in hesitation. It's important to remember that hesitation doesn't always lead immediately to a full reversal. Sometimes it turns into a sideways range before breaking out again. That's why patience is essential. You're not reacting to the first pause, you're studying it. You're observing whether the market regains its stride or continues to stumble. If the hesitation deepens, if rallies keep failing sooner, if lower highs begin to appear, that's your cue that the trend is decaying. This kind of reading takes practice, and it can't be taught from a book alone. You have to watch hundreds of charts over months and years, and pay attention to how hesitation looks in real time. Write down what you see. Note the signs. Smaller candles, shorter pushes, fading volume, weaker closes. Over time, you'll start recognizing the pattern instinctively. The best traders don't predict reversals. They recognize hesitation before others do. You'll also notice that hesitation feels uncomfortable. It tempts you to ignore it because it challenges your conviction. The trade that once made you feel safe now feels uncertain. You start looking for reasons to explain it away. It's just taking a breather. You tell yourself, but the market doesn't care about your comfort. It only cares about balance. And when that balance shifts, it doesn't announce it with fireworks. It starts with hesitation. Think about how many traders lose fortunes, not because they missed an entry, but because they refused to see that hesitation meant the move was ending. They watch their profits evaporate because they mistake fatigue for strength. I've seen it too many times. A man makes a killing on the way up, then loses it all because he couldn't bear to admit the tide was turning. Price hesitation was right there on the chart, plain as day, but he was too blinded by his own success to see it. That's why I always tell traders, don't fall in love with your trades. Fall in love with reading the market. Because the moment you care more about being right than about what the market is telling you, hesitation will sneak up on you like a thief.
Experience growth with Realize. Thousands of advertisers are already using Realize and experiencing growth. Realize outcomes at scale beyond search and social.
Home. Everyone you love. Everyone you know.
And by the time you recognize it, the reversal will already be underway. Price hesitation is your first and most reliable warning. It's subtle, quiet, and easily ignored. But it's also the earliest sign that something's changing in the market's heartbeat. Learn to feel that change, and you'll be ahead of most traders who only react after the storm hits. The market always whispers before it roars. The question is, are you listening? Heavy volume on down days confirms smart money distribution. That's a phrase that every serious trader should engrave into their thinking. because it's one of the simplest truths about market behavior and one of the easiest to overlook. You see, markets aren't driven by opinions or predictions. They're driven by transactions, by who's buying, who's selling, and how much of it they're doing. And nothing reveals the dynamic more honestly than volume. Price tells you where the market is going. Volume tells you who is behind the move. When price begins to fall and volume swells, it isn't random noise. It's a message from the professionals. It's the quiet confession that those who know the most, those who hold the largest positions, are unloading while the public is still dreaming of new highs. Most traders get fooled by the surface of the market. They see a dip and think it's a buying opportunity because the news still sounds optimistic or because the chart looks fine. But the tape tells a different story. When you see heavy selling volume on a down day, you're not just looking at red bars. You're watching smart money transfer risk to the crowd. The professionals don't ring bells when they sell. They distribute their stock carefully, quietly, and consistently into the hands of those who still believe the trend will continue. Have you ever wondered why a stock starts dropping hard on what seems like no bad news? That's because the insiders and the sharp operators aren't waiting for headlines. They're acting on behavior. When a trend is strong and healthy, down days come with light volume. It's natural profit taking, nothing alarming. The dips get bought, volume picks up again on rallies, and the overall tone stays constructive. But when the character changes, when down days suddenly come with surges in volume while rallies grow quieter, that's your first clue that something's shifting. The crowd often mistakes this as volatility. It's not volatility, it's distribution. The big operators are unloading. They can't just dump millions of shares in one go without crashing the price. So they sell strategically, on strength when they can and on weakness when they must. The tape records their footprints for anyone patient enough to read them. I remember watching the market during one of those roaring bull years. Everything going up, optimism in full bloom. The leading stocks were making headlines every week, and yet, when I studied the tape, I noticed something subtle. The advances were getting sluggish, but more importantly, the sell-offs were coming heavier. Volume was surging. The pressure was building. That was smart money stepping aside. The public, drunk on excitement, thought every dip was a bargain. They were buying what the professionals were selling. A few months later, those same bargains were down 50%. That's how the game works. Volume is the market's polygraph. It never lies, though it often hides in plain sight. When you see a stock dropping on big volume, you must ask yourself who's in a hurry to sell. Big players don't sell for no reason. They sell because they see something changing. Maybe valuation, maybe liquidity, maybe sentiment. The reasons don't matter. What matters is the action. If you pay attention, you'll see that before every major top, the pattern is always the same: big down days on heavy volume, small up days on light volume. It's the rhythm of distribution. The professionals are transferring shares from strong to weak hands. Now, I want you to picture the psychology behind this. During a bull move, the public becomes conditioned to buy every dip. It's worked before, so they expect it to work again. They see a down day and think, great, a discount. Meanwhile, the professionals see that same down day as an opportunity to sell more into the rebound that follows. They understand that distribution isn't an event. It's a process. It takes time. They use the crowd's optimism against them. That's why you often see markets make new highs even while the smart money is selling. They need those new highs to attract more buyers so they can continue distributing without crashing the price. Do you ever wonder why markets often top on great news? It's because the big players use good news to sell into strength. If you study charts long enough, you'll start noticing that the heaviest volume days often appear right before or right after a major turning point. It's not coincidence. It's the final phase of distribution. Think of it like a crowded theater. Everything looks fine until one person heads for the exit. Then 2, then 10, and suddenly the rush begins. The first to move get out easily. The last ones get crushed in the stampede. The same happens in markets. When you see price drop sharply on heavy volume, it's the big players heading for the exit. They're not panicking. They're efficient. They've already been unloading for weeks.
If you dare to be a pizza pro, the new stone-baked pizza mode from Frigidaire is all you. Just one of 15 plus cooking modes. It's dough to done in 2 minutes. When you dare to bring more flavor to the table, dare to expect more from Europe. Frigidaire.
That final burst of volume is simply the door closing. Volume also tells you about conviction. When a stock drops on low volume, it might just be a lack of interest. But when it drops on heavy volume, that's commitment. Somebody's serious about getting out. And when that happens repeatedly, you know you're witnessing a transfer of ownership. Professionals understand this intimately. They don't need indicators to tell them. They feel it in the flow. The tape becomes heavy, the bids vanish faster, the bounces get sold quicker. That's distribution at work. Many traders make the mistake of chasing strength without checking what's happening underneath. They see price rising and assume everything's fine. But if you look at the volume pattern and notice that each rally comes with declining participation, while each decline comes with surging activity, that's the market whispering the truth. It's like a man who smiles while sweating. He might look calm, but the signs tell a different story. The great irony is that the public always gets most excited right when the professionals are most eager to sell. During the final phase of a bull move, news headlines are glowing, analysts are raising targets, and everyone is convinced the trend will never end. That's when you start seeing those heavy down days appear. The first cracks in the wall, most ignore them because optimism blinds them. But the professional trader knows that heavy volume on a down day is never random. It's evidence. It's activity that can't be faked. I used to sit by the ticker and watch how the tape behaved after a long advance. You could tell when distribution began. The selling wasn't obvious, but it was persistent. Each rally met quiet resistance, and the volume during declines swelled noticeably. It wasn't panic, it was professional liquidation. The market was changing hands, and when the final stage came, when the last buyers stepped in, that's when the big operators finished selling. Then came the real break, and the crowd was left holding the bag. You have to understand something. Markets are like living organisms. They exhale before they collapse. Heavy volume on down days is the exhale, the release of pressure that's been building for weeks or months. It's the sound of professionals emptying their lungs while the amateurs are still inhaling. You can't stop it, but you can recognize it. This is why a trader who studies volume alongside price has a tremendous advantage. Price alone can fool you. A market can appear strong while volume quietly tells you otherwise. But when the two align, when price weakens and volume surges, that's confirmation. That's not fear, that's informed selling. And you must never ignore informed selling. Have you ever looked back at a chart and realized the days were probably there all along? The signs were visible, you just didn't listen. Gradually, during strength, in a way that barely moves price.
I've recently come to learn that a lot of founders market their company.
Thank you for joining the stream, guys. Make sure you get those likes up. Really
If
appreciate
you are a
it.
day trader and you are not doing top-down analysis, you are leaving money on the table. Let me explain. Top-down analysis is great for many reasons. It gives you context on the overall market, which builds your confidence and increases the accuracy of the trades that you take. It makes trading less stressful as a whole, and it's going to open doors to potentially massive trades that you wouldn't have gotten if you hadn't done top-down analysis. Now, I know as a day trader, you might think, I don't need to do it because I'm getting in and out of the market quickly, but trust me on this, if you bring top-down analysis in, your day trading results are going to get better, miles better. So in this video, I'm going to be putting together what I've found to be the best approach to top-down analysis for day traders. And this is from years of experience and and helping traders to make millions of dollars. So it's going to be broken down into two sections. We are going to have weekend work and we are going to have day-to-day work. The weekend work should take place probably on a Saturday or a Sunday. It's not going to take a lot of time, but this is just stuff that you definitely don't need to do every day. It's time consuming and boring if you do that. You can actually just do this once and then trade day to day with the structure that I give you. So on the weekend work, we are looking to analyze the high time frames. With this, we're going to develop narratives and we're going to build clarity around what the market is doing from a larger picture perspective. With all of this in mind, we can then move on to doing our day-to-day work, which is what we'll do for 10 to 15 minutes at the start of each trading day to actually execute setups inside of the big picture narratives that we've built in our weekend work. So day to day, then we only need to analyze low time frames. We need to build trading ranges to work within, and we need to make our actual executions, take the trades that we found through our analysis. Now the weekend work is going to take place on the weekly and the daily time frames. The day-to-day work is going to take place on the hourly, the 30-minute, the 15-minute, and the 5. Now I'm not going to include the 1. You can trade the 1 minute time frame if you really want to. But I think if you're watching this video, you're probably not profitable with your day trading yet. And the 1 minute is probably the hardest time frame to become profitable with. So I'm going to suggest you just stick to the easier ones. Go as low as the 5, but I would cut out the 1 for now. If you're not profitable yet, there may be a reason why. And I know 1 minute's exciting, but it might not be the most profitable for you right now. So what we're going to do is jump over to the chart right now. I'm going to run you through this top-down process from the weekly. Yes, I know that sounds crazy for day trading, but just trust me on this, all the way through to executing and managing a position. And I'll show you why this is just so good. Let's go. All right, so step number 1, that kind of weekend work. We want to begin on the weekly time frame. And our goal on the weekly, because we're day trading, is just to look at previous weekly candles and build ranges and narratives surrounding where the market could potentially go. Now, if we were doing swing trading, we may want to zoom out on the weekly a bit, kind of work out some of the areas of supply and demand that we could be looking to buy or sell from. But there is only really 2 things we want to consider from a day trading perspective. The first is previous weekly candles. So we're looking at this week's price action right now. This is where we're trading. If we look at the previous weekly candle, which closed, what we want to do here is try and get an idea of the momentum and who's in control between the buyers and the sellers in the market. Now, this candle shows a massive bullish push. Okay, we're looking at this blue candle here. If we consider the price action that this candle has printed and how this relates to the battle between buyers and sellers, we can see that this has wiped out 1, 2, 3, 4, 5, 6, 7 previous candles. So within just 1 week or 5 days of trading, we've erased 7 previous weeks of downward price action. This shows that buyers are very much in control. And by looking at this weekly, significant amount of buying pressure is likely to be bullish. So the immediate thing we buyers are very strong. So we can consider going into the new week with a bullish bias or an idea to go long or buy. The second market. So just to show you what that is, an efficient market is a market like the diagram that I'm drawing up, where every time we create a supply zone in price,
produce, the spice must flow. And this company is in the perfect position to capital.
In price, we move away and then we pull back and we retest that supply zone. Okay, so this is what an efficient range looks like. Now, an inefficiency is kind of like this push down, where we created a supply zone, which would be just here at the top, and then the market pushed away, but it didn't pull back yet. So the area that we create between where price is now and where the next supply zone is, that is the inefficiency. Now this works the other way as well with buys, okay? Any open price range created from an area of supply or demand creates an inefficiency. These inefficiencies are likely to be traded through, and they're also likely to create reactions when they've been filled. So if we have an inefficient price range, that can potentially act as number 1, a magnet for price, and number 2, an area for the market to react from. So for example, we have a small inefficiency down into here. If the market was to pull back to here, we would expect to see the market then push away. So if we had an inefficiency up here at the top, meaning if we had an open price range, say there was a supply zone and then a sell-off from there, we could consider that if the market was to reach the area of supply there, it would then reverse. So we would expect to see something like this. However, in this instance, we don't have inefficiency, okay? We just have this huge wick, which is an efficient price range. There is none of that imbalance that we've discussed. Now, when we have an efficient price range, so efficiency like this, and a target, which is just a massive wick, we have no real reason underneath this level for the market to reverse, right? So we can anticipate that the market will continue all the way up to this point and trade over this point, because at this point there is no reason for the market to reverse under this level. Okay, there we've built our bias. We have a massive push of strength from buyers, which gives us a bullish idea. We can expect that if the buyers continue, we are going to see the market going up, and we have no inefficiency. We have an efficient price range with the high topped out here, which will act as a very clear target for the market, which we could use for high time frame biases. Now, we don't always need to hold our trades up towards these massive targets, right? Because I know as day traders, you probably only want to be holding trades for a couple of hours, not a couple of weeks. But it does open doors to potentially maximizing profits on trades, which is something we're going to cover very soon. All right, so now we would go to the daily time frame. And once again, this is weekend work. All we're looking to do on the daily is, once again, just realign, make sure there is no inefficiencies that we should be aware of. And then we want to just take a look at the existing candle moves. Here we have 1, 2, 3, 4, 5, 6, 7, 8 consecutive bullish candles. This shows that buyers are very much still in control. We have massive strength from buyers here, and that reason leads us to believe that we should just look for opportunities to continue trading bullish, okay? We just want to move with momentum. If momentum is super strong, then we can use our day trades and our lower time frames to execute positions in line with the bigger picture narrative, which is, in this instance, exceptionally bullish. So nothing has really changed too much here by looking at the daily. The only other thing we can see here is that we've broken structure as well, once again just adding to the bullish narrative. And what we've done here, if we carried this work out on, for example, Sunday, we would now know for this week we are trading in a very bullish market. And our overall idea should be, if a day trade provides opportunity to buy, we should go with that. But if a day trade provides opportunity to sell, maybe we should think about this before we get into it, because we have a hyper bullish market with a very clear bullish target as well. So this big picture narrative gives us the idea to buy, not to sell. Okay? Now we can move into the day-to-day work, which is what you'll be doing on those lower time frames. So now we've jumped down to the 1 hour time frame. We still have our high time frame narrative target up here. And now we can start to look at the more close trading range. Now, for day trades, we don't need to worry about these massive imbalances being filled before we start looking for buying opportunities, okay? For a swing trading perspective, a trade would look something like this. If the market was to get into here, we would look to buy. But there is no guarantee, unless structure shifts, that we are going to be getting all the way down there. And because we are only looking for smaller movements, so we are simply looking to trade within, realistically, 1 or 2 of these hourly candles out of the existing price action. So what we want to do on the 1 hour time frame is build one for that day. The most simple way to build your daily trading range is to consider the existing swing point, the existing leg of price action. So the most recent leg of price action, we bottomed out here and we traded up all the way to here. This is around 4 hours of price action, right? 1, 2, 3, 4. And this is going to provide us with our daily trading range. Because we are bullish on the market overall, we know we want to buy, and now ideally our opportunity would be to buy within here, targeting here. This would be the general idea we'd look for. Now, sometimes daily trading ranges could be extended a bit further. Let's say we had an imbalanced demand zone somewhere around here. Well, then we could draw our daily trading range a bit lower, because it would then, in that instance, make sense for the market to trade lower and then still continue trading higher. But in this example that we're looking at here, we have no imbalances, right? You can see, as we've said, in line with that theory of efficient markets, every time we create demand, we push away, we pull back, and we retest. And then we push away, and we pull back, and we retest. Every one of these candles is retested with a wick, and there are no open candle bodies all the way down towards that point we discussed for potential swing trades. So because this range is efficient, this generally means that all of the orders have been filled, and there is no reason for us to go under this level. We do have, at this point, some small inefficiency, or at least we did just 1 moment ago, which would have been from around this candle here up towards this top. This pullback has started to fill the inefficiency. But this means that basically the only point we need to consider for our trades from an hourly perspective would be this demand. Therefore, creating our daily trading range between this low, this high, and our general consensus in line with the high time frame narrative will be buying there and targeting there, okay? So now we can go a little bit lower. Now the 30-minute time frame really doesn't tell us anything more in this example. It's a good one to check to see if we can find any opportunities from it. But for this one specifically, we're going to just go straight down to the 15-minute time frame. So on the
price action is just like any other language. Once you become fluent in it, you'll be able to read any price chart like this. If you're a trader who's serious about mastering the language of price action, keep watching this video. These are live trades that head trader and CEO of Quant Systems, Ali Moen Afshari, took live in front of 150 people.
On the 15-minute here, we have this area of demand. This could be a potential good place for us to buy from if the market came into it. Now, there would be two ways to approach a trade here. We could, number one, just use a buy limit directly into the market from this level. We would probably want to keep the swing low covered in this instance, though. And then if we were to set our target at the high, we're looking at only around a 2.5% return, which is okay, but we ideally would want to get more. I like to go for minimum 3R, meaning that I can win 1 in 3 trades essentially and still be profitable there, okay? So I want to make sure that I can get this above 3%, which means I'm going to do one of the biggest things about day trading and refine a little bit to see if we can find the best possible entry for this position. So going down to the 5-minute, we can see this demand zone could be refined towards this candle here. But we also see something very interesting here as well. And that is that we've got a demand zone just down here in the low. Now, an interesting thing about this demand zone, we have our top of demand here, and we see there is still a very small inefficiency into this level. So what we could expect to see is even though the inefficiency is very small, the market can come in and retest that level, and it likely will. If we take a look at the origin of this demand zone, we had a demand zone and then we had a push up here, which has broken some structure. This push up, breaking structure, tells us that the demand zone we're focused on, this one, has created a lot of demand, and we've seen a lot of buying coming into the market from this level. Now, if this is an area that major buying has taken place previously and it hasn't been filled yet, we can essentially see this very simple logic. If this is a discount price that people are happy to buy from in mass, it's probably going to be a discount price that people will be happy to buy from in mass again if the market gets into it. All right. So that would be a very high risk reward trade. But what I would do here, and we're going to look at a more confirmation focused approach. Retest it and then start to break structure to the upside. Why do we wait for this? And every step we've taken in this analysis journey so far, we built a time frame, the execution time frame, to also align with our bullish bias. Okay, so we want to make sure that the 5-minute is bullish in line with every other time frame that is also very bullish. So we wait for the market to come into this level. As we can see, it has done just that. And now the real structural point for this piece of price action would be this high here. So if the market was to close above this level, we could buy, we could have our stops in the range at a safe level, and then we can take this market all the way up to the high, okay? So let's jump this forward a little bit. See, the market's pushed up and created a closure above that previous wick. So we're just going to line that up. There's our closure. Now what we could realistically do would be use the demand zone beneath, just here, to enter a trade. And we can put our stop likely under the swing low with a better risk reward at this point. So we can buy here. We can have our stops under the low, our targets up into the high. And now we're looking at a 4.17% potential trade, right? So this alone, this setup, you could have potentially found something like this without the high time frame analysis. However, the risk you run by doing that is because you don't have much context. You may have seen that the market reversed sharply from here. So your immediate instinct may be to start selling. It's pushed down. We've broken multiple points of structure in this move. So if we pull back up, we will look to sell the market lower. The problem with viewing things from such a low time frame perspective there is that when you incorporate the high time frame narrative that we've looked at, it becomes completely obvious that this is the wrong thing to do. And it's the fact that we've done that high time frame analysis, that we have the clarity and understanding around what the market is actually doing. That's what's going to give us the confidence to take this trade. And that's what's allowed us to actually find this great position. So now we're going to look at actually executing this position. And the way that we're going to do it is we are going to open it in 2 sections. The reason we're going to do this is because I want to show you how you can profit maximize using top-down analysis. So my usual risk for a position is going to be 1%. What we're going to do is open 2 trades at 0.5% and leave one of them running. So we are going to use buy limit orders to get into these trades. Okay, that means if the market comes down to that level, we will be tagged into the position. We're going to open the second one as well, which is going to be another 0.5% risk. So now we're risking 1%. But what we're going to do is draw one of the take profit levels all the way up to that high time frame narrative target, which is all the way up here. This is a massive risk reward. So realistically, we've got a day trade with a 4% potential return. But we can, if we want to, optionally swing trade this into something that could get a massive return. Now, I know if you are a day trader, you're probably not going to hold trades for that long. But even if it got a little bit further, you're locking in a bigger profit. And because we have that understanding that the market is likely to go higher, why not hold some to maximize the profits that we can make on this move? So now with this said and done, let's just allow this trade to play out and you will see the process coming together. We have the high time frame, which built our initial bias and narrative for this market. And now we're moving into this lower time frame. And as you can see, we've reacted from demand and we've started to push up, and the market very quickly trades through towards that first target. Okay. Now you're going to see the beauty as well. The first trade is now closed and we have realized a profit of 2%. Okay, because we had a 4% trade and we've closed half. We have an unrealized profit of another around 2%. But what we can actually do with this one is hold it and move it even further into profit, which actually comes from the fact that we did that high time frame analysis and understood that the market is likely to go higher. And now I've moved.
Why do you keep missing the best trades? There's a reason Wall Street traders spot setups before you do. At S&B Capital, we're not your typical secretive Wall Street firm. Instead of hiding our strategies, we built our success by sharing them. Our New York trading floor houses dozens of professional traders, many of whom are...
And now I've moved over to TradingView because that trade cut me off. The back test ended. But we can see in real time now, at the time of recording this, that if we'd held this trade past the initial target of around 4%, which would have been the first overall target, if we'd have held a portion of that position out, it would now in real time be trading at 11.5 off, which at 0.5% risk is going to be around 6%. Okay, so you can see that just by having that high time frame narrative, which was to target the 1.71800 level, we actually managed to massively maximize the profits taken on this trade. We took around 2% profit there, and we'd be running a further 6% profit here. So we've turned a 4% trade into an 8% trade overall, just by having that high time frame narrative. And as I said, you may not want to hold trades all the way. Maybe you still want to get out within the day. But even if you did, you could have got out up here or even up here and added 1 or 2% to the profits that you'd have made on the move. To quickly recap the process, we are going to begin on the weekly and daily timeframes. And here, all we're trying to do is build a narrative. We're going to find high time frame directions, targets, and momentum using the weekly and the daily. When we've done that, we're going to go day by day to the hourly and 30-minute, where we build our trading ranges for the day. So the upper boundary and lower boundary of where our trades are likely to take place this day. Then we build our narratives inside of there to find our actual entry zones and the best place for stop losses. We then go to the 15 and 5-minute to kind of refine all of that, find our target, our entry, our stop positioning, and actually execute the positions that we've crafted through this top-down flow. And the weekly daily work should be done on the weekend, whereas the hourly down to the 5-minute should be done day by day. So this way you can get all of the benefit of the high time frame work without having to make it super time consuming and spending every day doing weekly analysis for pretty much no reason. Now, the next thing you need to do is go over to the top link in the description and join 7 Steps to Profitable Trades. In here, I show you how to build your first very own trading system. So we're going to go through the process of building a strategy and a trading plan that you can use to consistently, using the top link in the description. I highly recommend it. Thousands of people have been through it and I've heard nothing. That one's going to be beneficial for you as well. So thanks for watching, and I'll see you in that video or in the free course. Top-down analysis, an incredible concept where we use the high time frames, the medium time frames, and the low time frames, and we line them all up together to get the highest probability, highest accuracy, and highest reward trades possible. But there's one big problem that I want to address, and that is that many day traders believe because they're only going to be in their trades for a few minutes or a few hours, the top-down analysis is not relevant, and they don't need to be looking at those higher time frames. Now, in this video, I want to show you that that couldn't be further from the truth. And if you start to focus on the top-down process as a day trader, even if you're trading the 5 or 15-minute time frames, you're going to have better results and better performance in your trading because you'll get higher accuracy positions, less losses, and bigger wins as well. So with that said, let me teach you a top-down analysis process for day trading. All right, so here we're looking at a chart. This is a 5-minute chart. On this chart, we can see pretty much a fat load of nothing. This market isn't really telling us anything. And if we were trying to trade this from a low time frame day trading perspective, we're going to have a lot of difficulty finding a position because realistically, the market isn't doing or telling us anything. So instead of just looking at this in confusion and gambling a few trades as people do, what we can do instead is jump up to the higher time frames and analyze from the top down. And for day trading opportunities where you're trading anything from the 5 to the 15-minute time frame, I still recommend that you start on the daily. So if we go to the daily time frame here on Euro USD, we immediately get a better idea of what is going on. So the market right now, from this daily perspective, is somewhat downtrending. This downtrend has pushed past this low here. And this low here also formed equal lows. We've got 1, 2, 3 equal lows, which creates liquidity. Now beneath that, we have an imbalance. An imbalance is an open price range. This entire candle would be classified as an imbalance, but the market did come quite the way through it without quite filling it. So realistically, the imbalance that we have here is the area between the line we've just drawn and this demand zone. So that is our imbalance. Now immediately, we've picked up on a few different pointers that we wouldn't have seen from a lower time frame perspective alone. We have liquidity, 1, 2, 3 equal lows being swept, and we have a demand zone through an imbalance, and the imbalance is now filled. Demand zone, which is this last candle before the impulse, has now been retested. So now that we've had this sweep of liquidity, now that we've traded into this demand, what does that tell us? Well, that actually tells us that there could be opportunity here for us to take the market higher. So even though that lower time frame 5 to 15-minute market is just a complete mess, we've got an idea immediately just from looking at the daily. If we've seen sweep of liquidity, fill of imbalance, retest of demand, that could lead us into a bounce in this market. Now, if we also consider the trending structure, although this phase that we just discussed is indeed bearish, the larger phase of price action here, being from this low onwards, is actually pretty bullish. We have continual higher highs and higher lows, and we've now identified that this bearish trend has actually just been a pullback inside of the larger upward move. How do we know that? Because the break that's taken place here is not a clean break. It's not a break of significant structure. It's actually leading out to look like a sweep of liquidity and a fill of imbalance. With that said, we could then anticipate a continuation of further upside. Now, we are day trading. I haven't forgot that, which means that we're not really going to be looking to take this trade all the way through to a considerably higher level. We are instead focused on shorter-term moves, which means we want to take a trade that's going to be a few hours long with the opportunity to potentially stretch it out into something larger if the opportunity arises. So we don't need to stay up here on the daily, but we've got a really nice idea as to what could happen now. If we then follow the top-down process by going down to the 4-hour time frame, we will get a clear indication as to where we could start to target for positions.
What if there was a way to know if a stock would be bullish or bearish the day before? The truth is, there actually is one way.
Is your trading account suffering right now, but you're wondering, what do I do to start winning consistently and start making those big returns you've seen other traders make, the returns that you know are possible? Here's the honest truth. I struggled like that for a while. Trading did not replace my job for 15 years until I basically had a stroke of luck. My cousin, who's a professional stock trader, making over $2 million a year, finally had me over to his house and showed me some behind-the-curtain stuff, so to speak. I know that sounds a little storybook, but it was quite honestly the missing piece I needed to get to the next level. I was a decent trader before that, but once I learned to look at a specific set of...
So taking a look at this market from a 4-hour perspective, we see 2 equal lows, 1, 2, just there, swept. And we can see that the market is now rejecting that lower pricing, which is indicated by this wick that we're seeing coming up here. Now, this doesn't confirm anything yet, but it is a good indication that we could be going through with that reversal that we've just discussed. But one of the biggest things the 4-hour will allow us to do is refine our targets. So if we had that idea that the daily might potentially be turning bullish, well, now we can look for refined target opportunities. The first target we have in mind would be this supply zone just here. This is the supply. It's a very messy one, but basically, because of the imbalance that we've got running up here, that open price range, we'd anticipate that generally the market will at least make its movements up towards this point, okay? So there's a nice solid target for us. But above that, we can see we have this swing high. That could also be another potential target, and a huge open imbalance into this area here. So the imbalance, once again, is this open price range. And now we are provided with a few supply zones. So to mark supply, I used the last candle before the impulse, just here. This is the last candle before the impulse down. And we would do the same here, but it's a bit of a mess. So I'm actually going to draw it from the top of the wick down. We are ideally using this last candle before the impulse, but we should also account for that choppy news-driven movement. So just by looking at the daily and the 4 hour, that little range that we saw is no longer a complete mess. Instead, we have a pretty solid idea that the market could bounce from here. And we have some pretty solid targets that we can use for, number one, day trading. Number two, extending some of these day trades out into intra-week positions. So trades that we hold for a few days instead of just a few hours or minutes. These intra-week positions and being able to turn your day trades into intra-week positions is where a lot of the profit potential is maximized in your trading. I've taken positions before where I've entered with the plan of taking the 1 to 4 and then ended up holding for a 1 to 30 plus. Now, by no means are these common. This is a once every year or once every 2 year scenario, but these things can happen, and this is where they are born, from doing top-down analysis, okay? So now we can go down to the hourly time frame if we want to, and what we can do here is just refine some of these areas. The imbalance that we just drew now leads us up towards this point. So we can remove this as a target and extend that target even further into this point here. If we were to get the sweep, and yes, I know on the 4 hour we just saw it did push down lower, we would then be looking for continuation opportunities up towards this point. This would be our day trading format, and then we could potentially extend it even further into intra-week positions to tackle some of those larger areas we discussed. So now let's go down to that day trading time frame. I'm going to focus on the 15-minute. This is a good day trading time frame. You can go to the 5, you can go to the 1, but your results will be cleaner on the 15-minute because that is where the opportunities are going to be safer and more accurate. The higher the time frame, the more accurate the signals the market gives us. So we've turned an absolute mess that we looked at initially on these lower time frames into a fully fledged, fully viable trading opportunity. We identified these equal lows. We identified the possibility of bounce from this demand. We identified some targets. Now we can actually start to day trade this. So after Asia's session, we saw the market move down. We've seen that sweep of liquidity under here. And now we can use these lower time frames to actually day trade our way into larger opportunities. Okay. So here we have seen the market sweep this low. We've seen many bullish rejections coming in. Bullish rejections indicated by this collection of wicks. Wicks show rejected prices. So what we're seeing here is equal lows swept. And then we're seeing the market pushing back up. We're seeing a big influx of buying taking place here because the market's failing to close anything lower than this level, really, okay? So because of this, we know buyers are coming into the market. On the 15-minute here, we've also seen this shift in the structure. This is some internal structure from this larger movement. But for day trading opportunities, we can work with this internal structure. So what we've now seen is sweep of liquidity, bullish momentum coming in, shift in the internal structure. That is over this point at the highest, and then also some of these smaller points as well. And what we could do from this point is just follow out our usual plan. So for me, that's going to be looking for demand zones to buy from. I like to buy from demand and sell from supply. I don't really get into markets in any other way. So for me, sweep of liquidity, shift in the internal structure, this would be the demand zone that we could look to buy from. So what we have now is no longer just a choppy mess, but also opportunity to turn this into a significant trade. Now, another thing is with day trading. Let's say we wanted to target this high for a sweep, because this is the only target we could identify on those lower time frames. Our risk reward is not going to be so good, okay? The risk reward on this position would be 2.1. That's not great for me. I want to be taking more than 2.1 on the trades that I take. Generally, I want to take a 2.5, a 3 or more. So this would be a tricky one for me to kind of push myself to get into. In fact, it would go against my plan, so I wouldn't get into it. But because we've got that higher time frame narrative, we now understand the market could actually come all the way up to this point, which obviously is going to dramatically improve the trade. So,
a few years ago, this image almost broke the internet. A package of pears grown in Argentina, packed in Thailand and sold to consumers in the United States for just a few dollars, which led pretty much everyone who saw this picture to say, why the hell would you do that? On first blush, it seems outrageously impractical, if not wasteful. But the three-continent journey of this fruit cup isn't even the weirdest part of the story. The weirdest part of the story is that stuff like this is making all of us wealthier.
So now we have a 9.7% potential trade on the cards. We could potentially get into this and run it all the way up to this larger target. Now, this is where day trading can kind of intertwine with the higher time frame trading or the intra-week trading, okay? There is no reason realistically, unless you are trading futures, to get out of the trade before the day ends. If you have a clear target defined and the market is moving towards that target, you can hold trades longer. You can still use your day trading methodology to get into the positions, as we've done here, but you have the opportunity to hold the trades out for larger targets, okay? So now let's see how this trade goes. As you can see, we come down, we get a tap in, we then have a push away. Now there's also a secondary opportunity formed here, if you're a bit more conservative, where we have the true breaker structure, the market comes up, pulls down, trades into this demand, and then we can push away, we can put stops under the low, as we would, same target, that's all good. So let's just jump it back to the initial, just to keep it running through. Now we can see the market is pushing towards these highs, and where this could be the target done for your day trade, this would actually allow you to extend the profits further later into the day, okay? So let's take a look where the market gets to by the end of the day. The end of the day for me is going to be classified as around 5 p.m. UK time, which is just where we are coming into here. So at 5 p.m. UK time, that's the end of New York session. The lower volume timing starts here. If you wanted to take your trades and all the profits on your trades then, this would be where you'd be taking your profits, which means instead of just taking the 2-hour position, you could actually extend around a 4% position out of this market just by using those market timings and that top-down analysis process that we've ran through so far. But this is where the real beauty of this top-down process comes in. Now, obviously, first of all, the real beauty came in from the fact we turned this messy, unintelligible range into something that we could actually trade. But past that, it's the profit maximization that is so valuable. Because we know the market is likely to lead up towards these higher areas on the higher time frames, we can use this intraday entry to extend our profits dramatically. So let's say we wanted to be true to the day trading fashion and get out of half of our trade at this level. We'd now be taking 2% profits from this movement up, which is already good, already a nice return. But what we can now do is allow the trade to continue because we are still running 2% in profits as well now that we're at 4R. And because we have that higher time frame narrative, our trades, we're going to be a bit more confident holding them for the longer term. So if we hold this trade, we are now holding it through the night, into the next day, through London session, and then into the next day's New York session, we get a fill of that larger target, which would be 4.5 or 4.7% return on the other half of the trade, turning this initial 2.1 trade into a potential 6.7, something like that, okay, total. So we get 2% profit taken here and around 4.7 or so taken on the full fill of this move. And all you actually had to do here was not close the trade until tomorrow. You can close a bit, make sure you've got your day trading profits locked in, but because of the top-down move, we get to profit maximize and hold trades a little bit longer to let them get to those larger targets. Now, as I said, occasionally, not often, but sometimes, you'll be able to turn a day trade into something massively significant. If we take a look at the first initial target that we looked at in this market, the higher one up here, and we extend our targets up to this point for the second half of the position, we've now turned a very small profit potential trade of 2.1R into 22.5%. And obviously, being a day trader, it's likely that you want to take at least half the profit before the day is over. So you've taken your 2%, that still leaves open an opportunity to make 11.25% here on this continuation through, simply by not clicking the close button. It's really that easy. When you get into a market and you've got a solid narrative, all you have to do is just not close the trade. If you leave the trade running, like this one here, within just a matter of days or a week, you can get significantly larger profits from your positions. So this is where you benefit from using those day trading entries to get super refined stop losses, and then using that higher time frame picture to actually nail huge targets. Okay, small stop, large target, that's going to be some significant risk reward, and that would have turned this position into a full potential trade of around 13.5% or 13.25%, with that half taken here and half taken here. And let's take a look how long this trade took to play out. So this is running from the 14th to the 22nd of February, which means this trade was held for 1 week. It's really not a long amount of time to hold a trade that you can get this much profit out of, okay? And now from this point, obviously with the high time frame narrative in mind, we may have the idea that this is about as far as the market's going to get. So then we could go to the lower time frames from the supply and look for shorting opportunities to capitalize from the move back down. And that is how you can use top-down analysis to get more profits out of your day trades. If you do this, you will turn choppy ranges into very clear ranges to trade from. You've got that bigger picture narrative telling you the context you need to understand where the opportunities might come in. 5 minute looks like a mess, 15 minute looks like a mess, but if you go to the daily, things make a lot more sense in terms of where you can target and where you can get in. And the profit maximization you can get from doing this allows you to catch some of these huge, huge trades that, number one, will be very nice for your account balance, and number two, you can brag about to your friends. So that's it for this video. You should watch this one next, or head to the link in the description and join my free course. Thank you for watching. I'll see you in the next one.
New York drivers, do not pay your auto insurance bill until you hear this. The truth is, they're legally robbing you every time you pay for car insurance. Here's the deal.
In this masterclass, I'm going to teach you everything that you need to know about one of the best concepts in trading, supply and demand. We are going to go through all of this, and by the end of the video, you will fully understand the theory of supply and demand and how to apply it to find great trades. So with that said, let's get into the video. To briefly explain the theory of supply and demand, this is the thing that drives all markets. So we're looking at a price scale here, and when demand increases, so this will be our demand line, we see an increase in the price of an asset. So let's peg this to gold for this example. As demand for gold increases, the price of gold also increases. This happens because the supply of gold that's available, ready to trade in the market, declines with the increase in demand. Now, why does this happen? Why does supply fall as demand rises? Well, it's because, of course, if there are lots of people trying to buy an asset, i.e. there is lots of demand, then there are going to be people buying that asset, taking available supply off of the market. So that means as demand increases, more assets are bought up and the supply will decrease. A lower supply creates higher scarcity, and a higher scarcity demands higher prices because, of course, if something is rare versus something that's not rare, the price is going to be more expensive for the rare item. Okay, that is simply how it works. It's a very simple format. If we then saw demand start to slow down, so we saw the market coming back down in terms of demand, this would mean people are selling their assets. Now, if they're selling their assets, the supply is going to increase, okay? And as supply increases, of course, there are more readily available units in the market, which generally means if there is less scarcity, the price is therefore going to decrease. So as we see an increase in demand, we see supply lowering because the assets are being bought up. When we see demand decrease, we see more assets being sold to the market. Therefore, a lower price comes in due to the fact that there is now more available supply, less scarcity, and simply the fact that if demand's low, pretty much means no one wants the asset. To bring supply and demand into our actual trading and our technical analysis, we do this using zones. So this here and this here indicate supply and demand zones. A demand zone is an area in the market before a large upward move. So when we see a sideways bit of price action, can be an individual candle, I'll show you some examples in a moment, and then a large push away, this creates a demand zone. When we see the same, that kind of sideways price action of one candle or maybe more, before a large move down, this creates a supply zone. Now, to talk about the theory as to why this happens, basically the reason that we use this as our demand zone or our supply zone is because it's showing us where buying and selling pressure came into the market. Now, in order for the market to slow down, kind of recoil and consolidate before a large push up, that tells us that this region here, where it slowed down, where it went sideways, is where massive buying orders have been placed. That is why the market drove higher, because demand kicked in here, supply was bought up, the price appreciates because of that increase in demand and decrease in supply. In the supply example, here we see the area of consolidation before a large move down as essentially a point where new supply has entered the market. Demand has declined more assets have been sold readily available to trade. Therefore, with more supply and lower demand, the price depreciates. Now, the way that we actually trade these then is to buy demand zones when the market returns to them, or to sell supply zones when the market returns to them as well. So in the case of a demand zone, knowing that this area here is an area where significant buying has taken place, we know that this is what we could call a discount price. Okay, traders before saw this as a very good price to buy this asset, so they stepped in mass, and we saw that large drive of momentum. If we then get up to this point and we start to slow down, this is telling us that the price up here is no longer seen as a discount price to buy, and it's no longer seen as a good price to purchase this asset. However, we know, we have solid confirmation that this area here was indeed seen as a good place to buy from, a good price level to purchase this asset. So the theory is, and the concept is, if the market is to return to this price range again, we are likely to see a second phase of buying coming dated. You can be damn sure it's going to be seen by a lot of people as a good price to buy at again. The same goes for supply, except this is what we would call a premium price level. Okay, so this was a premium price to sell your assets at, whether you are, taking a buy trade and you're closing out for profit, or you're getting into a short sell position where you've sold with the intention of profiting from a down move. Regardless, it's a premium price to sell from. And now the market's lower. So if you're holding a buy, maybe you don't want to sell it down here. You'd rather sell it up here because the higher you sell it for, the more profit you're going to get. And if you want to get into a short position to profit from a down move, well, you don't want to do it down here, because if you do it from up here, you're going to get a much better entry, which means more profits. This entire range you could actually profit from instead of just, selling all the way down here and hoping the market doesn't return. So therefore, with this understanding that this is a premium price to sell from, if the market is able to return to this level again, this is going to be a prime place to place a short order and to profit, therefore, from the move down. So that is how supply and demand zones work. Let's take a look at those on real charts. So here we have a market that is in a downtrend. I'm going to identify a supply zone. I'll show you what it looks like in the real markets on a real candlestick chart. So we can see we have this big push to the downside. This candle here is an area of consolidation. Now, how do we indicate an area of consolidation or indecision? Generally, when we are plotting supply and demand, the simple rule is to use an indecision candle, and I like to use the last candle before the impulse. Okay, so what this means is, I don't care what color the candle is, but I want to see the last candle before an impulsive move away. So if we take a look at this one here, and we take a look at this one here, these are indecision candles. They are indicated as indecision by the fact they have large wicks and very small candle bodies. Wicks show rejective prices. So what we're seeing here with these wicks is attempts to go higher, attempts to go lower. And what we see with a small candle body is pretty much failure to get far in one direction either way. Okay, we didn't get high, we didn't get low in this given period of price action. So this creates an indecision candle. Now we are looking for the last indecision candle before an impulsive move. An impulsive move is a strong bearish or bullish candle, or a series of strong bearish and bullish candles. So you can see the candle I've just marked here. This is an impulsive candle. It's a large sell candle with no resistance from the buyers. We see as well, this one, after this indecision candle, is a large selling candle with clear strength from sellers. Okay, no resistance from buyers. So that is how we're going to be plotting these in real time. We want to see the last indecision candle before the impulse. Last candle before the impulse is the rule I use. Now, if you've learned supply and demand anywhere else before, you might have the last down candle before the up move, the last up candle before the down move as a rule. I don't use that. I use the last candle before the impulse. The reason I do this is because it is this candle here where the selling pressure has accumulated. Okay, it's not the last up candle where the selling pressure came in. This was a strong bullish candle. It's here. It's the very last candle before the impulsive move. It's exactly where the momentum has built up to create a selling move. It's the selling pressure. So that is the rule. Last candle before the impulse is going to be the one that we use for our supply zones. Okay. So now, to show you this example, we're going to focus in on this one. We're going to talk a bit more about differentiating zones a bit later. But for now,
when markets quake, the bull find diamonds in the panic. Most investors lose money.
But for now, we've got our supply zone. To mark a supply zone, we find that last candle before the impulse, and we want to mark the high to the low. That includes the wicks. So our supply zone would be this. Okay, we've just gone high to low of this candle what we would then expect is for the market to return to this level and then sell off from there, because we know that that's where the selling pressure has been previously placed once again. And this is going to be a supply zone. So we're going to mark it SZ. Why is it supply? Because it's in a downtrend. It's a selling move. Okay. Demand is obviously when we pull back to a buying zone. Supply is when we pull back to a selling zone. So this is a supply zone. So what we could generally expect to see from here then, having plotted that correctly, would be the market to return to here. We would look to sell there, and then we would profit from a new low being formed as the market falls. So just as a very simple example trade, we would have our entry there, stop above the zone, and our target down at the low. We're going to get more into all of this stuff soon, but first brief example, here it is. So there we go, we see the market push into the supply zone, and what actually discount price level, because that premium price has been hit. Sellers that sold here before are more than happy to sell here again. And you get this nice positive movement straight down to your target, which is of course how we make profits from supply and demand. Now, one very important thing about supply and demand is that you use it in line with the overall trend direction. So we can see this market is falling. It's creating lower lows and lower highs, meaning every low is lower than the previous one, and every high is lower than the previous one as well. So what this tells us is that the market is in what we call a downtrend, okay? And in a downtrend, we only want to focus on selling supply zones. We do not want to buy demand zones. If we take a look at this market, we have multiple areas we could see potentially as demand zones. But if we were to buy these every time the market came into them, we would be destroyed, okay? All of these areas would classify as demand zones. But if you were buying here on the way down, you're buying here, you're going to get killed. You're going to lose loads of trades. So the kind of sneaky thing about supply and demand is that supply and demand zones visibly appear everywhere, but you need to trade them in context. So in a market that is moving down, we only want to sell from supply zones. We do not want to focus on demand zones. Now I'm going to give you a very quick class on market structure to explain it. Let's go. So through this phase of price action just here, we can see the market is creating higher highs and higher lows. Okay. So a higher high, very simply, is just a high like this that's been printed in the market that's higher than the previous one. Higher lows, again, it's just a low that's higher than the previous one. So as the market is creating higher highs and higher lows, that puts it in an supply through here. So this is an uptrend. We want to buy. At this point, we see the market shift, and it actually breaks into what we call a, therefore it's a lower low. And through any phase of price action where we can clearly define the market is creating lower lows as well as lower highs, we want to be selling supply. So if the lows start to form lower than the previous ones, and if the highs start to form lower than the previous ones, this puts us into a downtrend. And during a downtrend, we want to pretty much ignore demand zones. And in here, we want to sell supply. Now, there will be a card in the top corner of this video. If you really want further depth on market structure, lucky for you, I have a full masterclass on that as well. Click in the top right somewhere, and that'll take you to it. So here we have a market that is creating lower lows and lower highs. Therefore, what would we want to do? We would want to sell from supply zones. Now, an extra little lesson woven in here. I'm going to use this sideways candle, this pullback candle, this kind of indecision candle in this downward move as supply. As we can see in this example, there is a little wick here that extends further on the next candle. So I would actually use this candle to mark my range, the blue one, but I will extend the high of the zone to the wick that's been created by the next following candle. Okay, so we use the high there down to the low here. That creates our supply zone. So the idea is then we are going to sell supply because the market is currently downtrending, creating new lows and new lower highs consistently. So that would be pretty much where we get into a trade from that point onwards. And as we see the market coming down, of course, we can then just continue selling supply zone. So we see again indecision candle, the market pulls back to supply. That would be another opportunity to sell. Okay, so that's the general idea as to how we focus on a downtrending phase of price action. Now, as we can see, coming in from this point, we are starting to push to the upside. Taking a look at the structure, we actually pushed over this high. So we have a high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. The market's pushed up, and now it's created a higher high. So this actually puts us into an uptrend. Okay, meaning what do we want to do in uptrends? We want to buy from demand. So here's our indecision candle, our sideways candle before the impulse. Last candle before the impulse is what I use for my zones. And what we want to do at this point is buy from demand, meaning any supply zones that form will be ignored. Okay, you can see that demand zones did form in this move up, but we ignored them and focused on selling supply because the market direction was down. Now that we've shifted up, we want to focus on buying demand, and we want to ignore supply because the market direction is up, and we are moving with the market direction, using supply and demand to make our executions. So, in one moment you will see market returns towards this area of demand, and then we get a tap in and push away into new highs. So that is how we use supply and demand in line with the trend, with a real example there of a downtrend, selling supply, and an uptrend, buying demand. So in order to validate a supply or demand zone, we need to make sure there is something we call an imbalance. If there is no imbalance into a zone, then it's not a zone that we want to look at. If we take a look at where I'm drawing these black lines, we can see just above this candle here, this blue candle, is going to be our supply zone. Okay, it's the last candle before this impulse to the downside. Now we can see what we have beneath the low of that candle, and then above where price currently is, there is an imbalance, right? An imbalance is an open price range. It's this area here. Basically, what it is an area that hasn't been filled yet with wicks. If this candle had pushed up and hit that area, then this would have created what we call efficiency and removed any imbalance into that zone. But because we still have this open price range here, that means that there is imbalance into this supply zone. So this would be a good supply zone to sell from, okay? And we would expect when the market comes back to it, we could happily sell from this point because that would fill the imbalance and then the market would be likely to move lower. Now you have to have an imbalance to your supply or demand zone, otherwise it's not really valid. So if we take a look above, we've got here this indecision candle. This is the last candle before an impulse to the downside. And just to clean it up, let's get rid of this. We'll get rid of this. But the problem with this zone is there is no imbalance into it anymore, right? So here we have our supply zone. We have a push away, the market's pulled back, filled imbalance, and pushed down. So initially, if you were looking at this supply and you wanted to sell it here, that would have been okay. But now that this has already been filled, now that there is no imbalance, this would not be a good supply zone to try and sell the market from. For two reasons. Number one, the market probably isn't going to get there because it's probably going to react from the area with the imbalance. Number two, if it does get there, because the imbalance has already been filled, it probably isn't going to give you a good